1031 Exchange Basics in 10 minutes and 31 seconds, hosted by Asset Preservation, Inc. And right off the bat, please look at the disclaimer. We can't cover everything in a short presentation, so please review your unique facts and circumstances with your tax and/or legal advisor to get their input and their tax advice. Starting off, let's look at the difference between a taxable sale and a 1031 exchange. In a taxable sale, a taxpayer gives up property and they receive back cash or other consideration. In a 1031 exchange, a taxpayer gives up a property that's held for investment or used in their business, they give it up, and they receive back like-kind property. So sale, property in exchange for cash. In an exchange, property is given up, like-kind property is received. Now the code itself, and I'll read it, states, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of a like kind, which is to be held either for productive use in a trade or business or for investment. Some key takeaways. First off, this is what we refer to as non-recognition treatment. It is not a tax-free exchange. It is a tax-deferred exchange. So the basis of the property being relinquished, the one being sold, gets rolled into the basis of the replacement property, the property being acquired. So it's a tax-deferred exchange. The types of property are very broad. You can exchange an investment property for another investment, business for business, a business use property for an investment, or an investment property for a business use. And we'll look at this in more detail. The reason somebody looks to do an exchange is because they're facing a significant capital gain tax burden. So there are 4 levels of taxes to look at. First off, depreciation recapture is taxed at a rate of 25%. Then the remaining federal economic gain is taxed at either 15% or 20%. Next, some taxpayers face what we call the net investment income tax. So it's an additional 3.8% tax on income over certain thresholds. So over 200,000 for single filers, over 250,000 for married filing jointly. And then finally, state taxes. Some states have no tax at all. Other states have much higher taxes, like California has a maximum tax rate today of 13.3%. So you want to get with your CPA and your tax advisor and look at the cumulative effect of all 4 levels of taxes to find out what you might owe if you proceeded with a taxable sale instead of a 1031 exchange. Now, the concept of like-kind property, there's a little bit of confusion still in the marketplace, but it's very broad. Any property held for investment purposes or used in your business can be exchanged for any other property held the same way. So bare land can qualify, a ranch, a farm, a single family rental, retail, industrial, office, even vacation homes held for investment. Maybe an easy way to look at it is what type of property is excluded. So the home you live in, your residence, you can't exchange. That's another tax code provision. Section 121 of the code covers that. And then property held for sale purposes or dealer property. So if the intent is to hold for sale, not long-term investment, that property is excluded. Any property that is held for investment can be exchanged for any other property also held for investment purposes. And the final bullet point on the screen, it gives some examples. The definition is very broad. It can be raw land, commercial, single family rentals, multifamily, which are apartment buildings, office, industrial, easements, certain air rights, water rights, vacation home held for investment that meets the requirements of Revenue Procedure 2008-16, and then certain fractional ownership programs referred to as Delaware Statutory Trust and Tenant Common Ownership. Now, an important concept is, what do you need to do for full tax deferral? If you want to defer all capital gain taxes, you need to, number 1, reinvest the net equity. Number 2, have the same or a greater amount of debt. To the extent you receive cash, we call that cash boot. To the extent you receive a reduction in the mortgage liabilities that is not offset by adding new cash, we call that mortgage boot or debt relief. An example, somebody sells for $900,000, Their mortgage that was paid off is $300,000. Subtract out the closing costs. Remember, we're talking about the net sales price. So take out the closing costs, real estate commission, title company fees, leaving $540,000 of net equity. This taxpayer then is going to go ahead and buy a replacement property for $1.2 million. Their debt goes from $300,000 to $660,000, no mortgage boot. They reinvest all of their cash, so there is no cash boot. So this is an example of 100% tax deferral. Now let's look at the next slide, and we'll see an example where there's partial deferral. This taxpayer goes from $300,000 down to $260,000 of mortgage. So there's $40,000 of mortgage boot. They take $100,000 out of the exchange. We call that cash boot. Add the $40,000 mortgage boot plus the $100,000 cash boot, and there's $140,000 of total boot. Now let's look at the most common exchange variation called the delayed exchange. The exchange starts off with the taxpayer, so that's the real estate investor, the business owner. They get a property under contract, and then important, prior to closing, they contact a qualified intermediary like asset preservation. We prepare some exchange documents, and what we do is we step into their shoes with an assignment of their contract over to asset preservation. We sell the property to the buyer. We instruct the closing officer to directly deed it. We receive the proceeds from that, and we put them in a separate account where they're held on behalf of the taxpayer. So that starts the exchange. Then they look for property they want to buy, replacement property, get that under contract. Likewise, by preparing some exchange documents and an assignment of the contract, we step in as the buyer of the replacement property with the money we're holding. We purchase it. We then instruct the closing officer to directly deed that property back to the taxpayer. So the qualified intermediary, sometimes referred to as a QI, sells the relinquished property. The qualified intermediary buys the replacement property. Now you look at some key timelines down at the bottom. Day 0 is when the property closes, and that starts what we call the 45-day identification period. So the taxpayer has until midnight of the 45th day to identify property. They then have another 135 days after that for a maximum of 180 days to acquire replacement property. So we call that the exchange period. And keep in mind, the maximum is 180 days. If they are going to file their tax return in the year of the transfer, it's whatever is earlier. So that might be shorter. There are different ways to identify property. One common approach is what's known as the 3-property rule. The taxpayer can identify 3 properties at any fair market value. Under the 200% rule, they can identify as many properties as they want, but no more than 200% of what was sold. So if they sell for $1 million, they can't identify over $2 million. And then finally, the 95% rule says the taxpayer can identify more than 3 properties and more than 200% of what they sold, but then they must actually close on 95% of those properties. In terms of the identification requirements, it's got to be done in writing. The property must be unambiguously described. So a specific property, a specific street address, a specific condo. This has to be done by midnight of the 45th day. Generally, this is sent to the qualified intermediary. So we'll go through the highlights of a delayed exchange. First off, you want to consult with your tax advisor and a qualified intermediary prior to closing on the sale and look at your tax consequence. You want to make sure that the sale contract can be assigned over to the intermediary and that the buyer is made aware of this. In a couple slides, you'll see some suggested language. Then the qualified intermediary gets their documents over to the closing officer prior to closing on the sale. The taxpayer has 45 days to identify property, and then a maximum of 180 days to close on property that's identified. On the next screen, you can see some language for the 1031 exchange cooperation clause. Contact Asset Preservation. We'd be happy to email this over to you and your real estate professional. Finally, due diligence. This is the most important issue, is the security of the exchange funds. Paramount to everything else is the security of those funds. This is an area at Asset Preservation where we really shine. We call it the Asset Preservation Advantage. We've been doing exchanges since 1990, and we've done over 200,000 exchanges. We've got very experienced staff on board, senior counselors in a commercial division, and we're backed by Stewart Title. We offer a written letter of assurance upon request to taxpayers that would like this. Finally, you can find asset preservation on some of the social media. And then wrapping up, if you want to contact us about your situation, call our national headquarters at 800-282-1031, our Eastern Regional Office, New York at 866-394-1031. Visit our website, apiexchange.com, or please email us at info@apiexchange.com.